Hello, welcome back to Advanced Financial Accounting class. This is the third module. Today we will look into accounting for property, plants, equipment and intangible assets, accounting for PPE and intangible assets. We will look at the recognitions and initial measurement of non-current assets, subsequent measurement model, depreciation and amortization principle, revaluation of assets, the recognition and disposal of assets, and lastly, difference between IFRS and US GAAP treatment as it pertains to PPE. Property, plant and equipment and intangible assets represent significant investment and often form the largest portion of non-current assets on the statement of financial position. This asset provides the essential infrastructure for generating revenue and creating value over multiple accounting periods. This module explored a comprehensive accounting framework governing these assets under both international financial reporting standard and the US GAAP. Let's look at the recognition and initial measurement of non-current assets. An item of PPE or an intangible asset shall be recognized only if it is probable that future economic benefit will flow to the entity and its cost can be measured reliably. And the cost of PPE includes the purchase price, directly attributed cost, and the initial estimate of decommissioning or restoration costs. Costs that are not directly attributable to bringing the assets to its intended use, such as staff training or advertising, must be expensed as incurred. Let's look at borrowing cost and capitalization, which is under IAS 23. Looking at the borrowing costs, they are actually directly attributable to the acquisition, construction or production of a qualifying asset, and this must be capitalized as part of the cost of that asset. And the qualifying asset is one that necessarily takes a substantial period of time, generally more than 12 months, to get ready for its intended use or sales. Capitalizable borrowing costs include the interest on loan, amortization of discounts or premium, and exchange differences on foreign currency borrowing related to interest. An intangible asset must be identifiable, meaning it is either separable or arises from contractual or legal rights and must meet the recognition criteria of probable future economic benefits and reliable cost measurement. Intangible assets that are internally generated are recognized only in the development phase. Once technical feasibility has been demonstrated and all recognition criteria are met, and research phase costs are always expensed as incurred and cannot be capitalized under any circumstances. Looking at the subsequent measurement model for PPE and intangible assets, after initial recognition, entities may choose between the cost model, which carries assets at cost less accumulated depreciation and impairment, and the revaluation model, which carries assets at fair value. The revaluation model is available for both PPE and intangible assets, but it is rarely used for intangible due to the rarity of active markets, and the chosen model must be applied consistently to an entire class of assets and cannot be applied selectively to individual assets. Looking at the depreciation and amortization principle for PPE and intangible assets. Depreciation is a systematic allocation of the depreciable amount of a tangible asset over its useful life, while amortization applies to intangible assets with finite useful life, and the depreciable amount is the cost of an asset or its revalued asset less the residual value. While depreciation method includes straight line, diminishing balance, units of production, and sum of the year digits, and the chosen method should reflect the pattern of economic benefit consumption. We have the components of depreciation and changes in estimates, and when parts of an item of PPE have different useful life or benefit patterns, each component must be depreciated separately under IFRS, and changes in depreciation estimates such as the useful life or residual value are treated as changes in accounting estimates and are applied prospectively, and this means that the carrying amount of asset is depreciated over the revised remaining useful life without restating prior periods. And the revaluation model and accounting for revaluation. Under the revaluation model, increases in the asset fair value are credited to the revaluation surplus in entity through other comprehensive income unless they reverse a previous evaluation decrease recognized in profit or loss. And revaluation decreases are recognized in profit or loss to the extent that they exceed any previous revaluation surplus for the same asset, and the revaluation surplus may be transferred to retained earnings when the asset is recognized or as it is used through higher depreciation charges. Under the recognition of and disposal of assets, an asset is derecognized upon disposal or when no future economic benefits are expected from its use or disposal, and the gain or loss on disposal is calculated as the difference between the net disposal proceeds and the asset carrying amount at the date of disposal. Any remaining revaluation surplus related to a disposed asset is transferred directly to retained earnings within equity and does not pass through profit or loss. The key differences between IFRS and US GAAP. Under IFRS, it permits the revaluation of PPE, while the US GAAP prohibits revaluation and requires cost model. The IFRS mandate component depreciation for PPE, whereas US GAAP permits but does not require it. IFRS allows impairment reversal for assets other than goodwill, but US GAAP prohibits any reversal of impairment loss. And development costs may be capitalized under IFRS if criteria are met, but under US GAAP, most development costs are expensed as incurred. Looking at financial statement impact on asset accounting choices, the choice between the cost model and revaluation model significantly impact the statement of financial position, as revaluation can increase asset value and equity through the revaluation surplus. Capitalizing versus expensing borrowing costs and development costs affect both current period profitability and future amortization expenses, and this accounting decision influences key financial ratios such as the return on assets, the debt to equity, and earning per share, which are critical for stakeholder decision making. The professional judgment in asset accounting. Accounting for PPE and intangible assets requires significant professional judgment in areas such as determining useful lives, selecting depreciation method, assessing impairment indicators, and applying the revaluation model. And ethical integrity is essential when making these judgments to ensure that financial statement provides a faithful representation of the entity's financial position and performance. Accountants must balance technical compliance with the need to communicate economic reality transparently to users of financial statements. In conclusion, proper accounting for PPE and intangible assets is fundamental to transparent and reliable financial reporting. A mastery of the principle covered in this model equips professionals to handle complex asset accounting scenarios with technical accuracy and ethical judgment. As future accounting professionals, you will play a critical role in ensuring that asset values are reported faithfully, supporting informed decision making by investors, creditors, and other stakeholders. Thank you.